This video is brought to you by togetherbudget.com. House hacking is a strategy where you live in a rental property and pay less than your fair share of rent, often by taking on a roommate or two. This approach allows you to build equity in a home while minimizing upfront costs. One popular house hacking strategy is the house hacking triad. This involves finding a triplex or fourplex where you live in one unit and rent out the other two. By spreading your expenses across 3 units, you can reduce your mortgage payments and build equity faster. Another house hacking strategy is the lease option. This involves renting a property with an option to buy at a later date. By leasing a property, you can test the local real estate market and negotiate with sellers who may be motivated to sell. House hacking also involves understanding and managing expenses. This includes paying for utilities, maintenance, and property taxes, as well as considering insurance costs and potential repair needs. And when investing in real estate, it's essential to understand that you're not just using your own money, you're leveraging other people's capital to increase your returns. And this concept is often referred to as other people's money. And by utilizing OPM, you can multiply your wealth and achieve financial freedom more quickly. Next, analyze the property's layout and square footage. Opt for houses with at least 3 bedrooms or an open floor plan that can be repurposed into additional living spaces. Examine local market trends and rental rates. Look for areas with high demand, moderate prices, and a diverse range of income levels to ensure consistent tenants, and evaluate the property's maintenance needs, including any necessary renovations. Factor in the costs of repairs and updates when determining your offer price. Safety and security are top concerns for house hacking. Research neighborhoods with low crime rates, good schools, and a strong sense of community. Ensure that the property is well maintained and secure to protect both renters and owners. This will also help maintain property value over time. Fannie Mae and Freddie Mac are 2 government-sponsored entities that play a crucial role in making home ownership more accessible to Americans, and they purchase mortgages from lenders, package them into securities, and sell them to investors. This process helps to free up capital for lenders to make more loans, increasing the availability of mortgage credit. Purchasing a property with multiple units is often more expensive than buying a single-family home, but it can also provide a higher potential for rental income and greater financial returns. This is because you can rent out the additional units to tenants, offsetting your mortgage payments and generating passive income. And when purchasing a property with multiple units, consider the location and local market conditions. And is it in a high demand area? Are there any upcoming developments or changes that could impact rental income? Researching these factors can help you make an informed decision. In addition to rental income, consider the potential for long-term appreciation in property value. As the area develops and and more people move in, the value of your property may increase. This can provide a safety net in case of vacancy or other financial setbacks. When financing a property with multiple units, lenders may require more stringent requirements due to the higher potential for vacancy and decreased liquidity. Be prepared to provide additional financial information and documentation to secure a loan. House hacking is all about leveraging other people's money to acquire and manage properties that generate passive income. Lease options and owner financing are two alternative paths to explore, allowing you to control a property without taking on its full financial burden. Lease options give you control over the property while allowing the owner to retain some rights. For instance, you might sign an agreement to lease an option to buy at a predetermined price within a certain time frame. Owner financing offers an alternative to traditional bank loans where the seller becomes your lender. This approach allows you to negotiate better terms and potentially lower interest rates to successfully execute lease options or owner financing. It's essential to understand local laws and regulations. Research and familiarize yourself with the rules governing these alternatives in your area. When managing cash flow and budgeting for maintenance, it's essential to track income and expenses accurately. Create a dedicated spreadsheet or use accounting software to record every transaction related to your rental properties. Categorize expenses into fixed costs like mortgage payments, property taxes, insurance, and maintenance fees versus variable costs such as repairs and utilities. This distinction will help you identify areas where you can optimize spending and allocate funds more effectively. Well-planned maintenance budget should account for 10 to 15% of the property's annual gross income. Allocate funds for routine upkeep, unexpected repairs, and capital improvements. Consider setting aside a separate fund for each property to maintain a cash reserve for emergencies. Regularly review your expenses to adjust your budget accordingly and make informed decisions about renovations or replacements. A cash reserve is essential for covering emergency expenses such as repairs or vacancies. Aim to save 3-6 months worth of operating expenses in a separate account. This fund will provide a financial cushion during unexpected events and prevent you from having to dip into your primary savings. Regularly review your cash flow to ensure the reserve remains adequate.